Welcome back. In this episode, I want to talk about Uber and what I'm looking out for in their upcoming earnings call on February 5th. Uber is a stock that's been facing a lot of negativity recently, primarily because of Tesla's and Waymo's advancements in autonomous vehicles. Since Uber's all time highs here in October of last year, the stock is down nearly 21% today. It was even down as far as 30% at one point in the span of just 2 months. That's why I want to review Uber's current valuation and their growth, both past growth and future expected growth. Then we're going to see what Wall Street analysts and fund managers have to say about the company. I have a few videos lined up highlighting both the bullish and the bearish takes on the company. After that, I'll tell you what I think is most likely to happen and if I'm buying the stock or not. Let's jump in. So, there are a few key things I'm looking for in the upcoming earnings. First, continued growth in both monthly active platform users and the total number of trips completed. As I mentioned at the start of this video, Uber has been facing a lot of competition from Tesla and Waymo, or at least that's what the stock price is telling us. I want to see continued growth in Uber's numbers in this earnings call for two main reasons. One, until Tesla and Waymo's impact on Uber is seen in the actual numbers, I think the recent negativity is being blown way out of proportion. Two, if Uber is to survive, they really need to continue growing their incredibly valuable network of users as fast as they can. The value and convenience they bring to the market is their biggest advantage, and they really need to keep that up. Now, moving on to Uber's growth, it's simply incredible. Look at this. If we start with the revenue, as you can see, over the past 5 years, Uber has grown revenue at an average of 26.3% per year, and that's on a trailing 12-month basis. And trailing 12 months basis just basically accounts for the previous 4 quarters instead of just 1 quarter, and is really just used to smooth out any short-term fluctuations and give you a better picture of the company's trajectory. Now, growth has slowed a little bit in the recent years, but 16.7% for a company of Uber's size is still incredible. Looking at the earnings per share, this company recently flipped to profitability, so we kind of have to wait and see how this plays out. However, with the rising revenue and operating margins, I'm expecting profitability to continue to grow pretty rapidly. Now, moving on to the monthly active platform users. They're growing incredibly well here too. More and more people are using their platform every month, and they're now up to 161 million users using their platform every single month. And the same goes for trips. In the last quarter, they completed just under 3 billion trips, and this metric is also growing incredibly fast, as you can see. And if we look at the gross bookings here, which is essentially the revenue from all of their different business segments before fees and deductions, we can split this up by the different segments. So you can see that mobility is still what's growing by far the fastest. Delivery is still growing, but not as fast. And freight is just still such a tiny part of their business that it's almost irrelevant. Lastly, if we look at free cash flow, Uber currently has a very nice free cash flow yield of 4.2%. And if we look at the graph here, free cash flow is also growing incredibly fast, and I expect that to continue. And to explain a little bit what free cash flow is the money a company has left over after it pays for its regular business costs. So, like salaries, rent, and other operating expenses, and any big expenses needed to maintain or grow their business, such as investments in technology or infrastructure or more equipment. As you can see, Uber's cash flow is growing very quickly, and the reason for that is largely because of simply earning more money from rides and deliveries and their relatively new Uber One subscriptions. The company has also been cutting back on incentives and deals, so they're actually keeping more money from each ride. And since Uber doesn't own any cars and they're generally a very asset light business, meaning they don't have a ton of stores or offices or like physical expensive things, it's all just software, it's the app. That means that their earnings can continue to grow while their expenses don't grow nearly as fast. And as they earn more and spend less over time, their profit margins and profitability continues to improve over time. And over the past few quarters, the company has become much more disciplined with their spending, and they're no longer just prioritizing growth over everything else. And they're even starting to use some of that excess cash to buy back shares and return value to shareholders. With a company that's likely to continue growing cash flows like Uber is, we could even see a dividend at some point in the future. Or they can use that cash flow to get their balance sheet in a better place and pay back some of their debt that they have. So that's why free cash flow is important. We want to invest in the businesses that can print money, and the amount of money they print continues growing over time. And all of that growth comes with a forward PE of just 26, which is pretty much in line with the market. So this company is very undervalued in my book. Now let's hear what some of these Wall Street analysts and fund managers have to say about Uber. We'll hear arguments from both sides, and then I'll play a video from the Uber CEO just for a quick recap on last quarter's results and his outlook for the future. Starting with Mark Mahaney.
Tech has been the second best performing sector in the S&P this year, behind communications services, which also includes a lot of tech companies, too, depending on how you define them. Our next guest says he remains constructive on internet stocks heading into 2025. Joining us now with his top picks for the year is Evercore ISI Head of Internet Research, Mark Mahaney. Mark, thank you for joining us on this holiday week. Let's get right to it. How do you see 2025 shaping up in your sector? What are some of your top picks?
Probably the same way that 2024 is ending. It looks like demand trends remain reasonably robust, whether that's online retail, advertising, travel, cloud, mobility, delivery. There's a series of verticals within the internet, but the growth rates seem to be, frankly, a little stronger at the end of 24 than they were at the beginning into 24. There's more certainty, and I think that'll hold next year. We'll also probably continue to have very high margins. We had a slew of record high operating margins in the September quarter. I think those are largely sustainable. And then you've got this, what I call the gift that keeps on giving, which are these AI deployments, which are just improving processes, creating new revenue streams, allowing companies to grow with much less headcount growth than they needed in the past. So for investors, there's a lot of goodness in the sector. A good chunk of that is priced in. There's very little dislocation in this space. Our number one pick, really the only large cap stock that I think is dislocated, is Uber. Number two pick is Amazon. Number three pick is DoorDash.
That was exactly my next question, which was this idea of where you see specific catalysts for these and whether you believe that the market isn't fully appreciating that thesis and if there is a gap or a potential for investors to get in now.
Well, so here's my pitch on Uber. It's very dislocated. The stock's underperformed on the year. It's roughly flattish on the year, and a S&P 500 sector that's up 20%, and large cap internet's up 40%. So you really got an underperformance here, but it's really triggered by this sell-off recently from, call it the mid 90s down to 60 on the thesis that Uber is going to be robo-taxi roadkill. And it may well be. I mean, that's a possible outcome here. I just think that I'm taking the other side on this. The stock's had a 30% plus correction. That makes it dislocated in my book. And I think it's still a very high quality asset. The world leader, global leader in terms of market share in both delivery and mobility, with an ads business that's building up. You know, it's part of the lucky lexicon, like Uber. Everybody sort of globally knows what the brand means and what it does. It allows them to spend less and less on marketing over time. So the real debate is on robo-taxis, but I think it's the largest demand aggregator out there. I think chances are we're going to see robo-taxis as part of your Uber app in the future, both on the definitely on the mobility side, maybe on the delivery side too. So I can't guarantee that, but I know that the market is so negative on that thesis that I think it creates the opportunity asymmetric upside. So that's why we're long Uber.
So that was Mark Mahaney's take. He clearly thinks that Uber will have a place in this autonomous vehicle world. Now, moving on to the next video, we have Brad Gerstner, a hedge fund manager, and he highlights the other side of this argument. And Josh Brown has a small segment at the end of this video too.
I have to admit, I was shocked when I saw this today because of how bullish you've been on Uber.
Yeah.
You sold it.
Listen, let me say at the start, Dara has been an incredible CEO at Uber. He's dramatically increased the free cash flow. He's increased the competitive, position of that company. They're the dominant leader now in global mobility. We love the company, and it's inexpensive. However, leading up to the election, right, we have been taking down our position size, and we've been rotating into Tesla. Why? Because I said before, we had a ChatGPT moment around full self-driving in 2024. I think the year of 2025 is going to be about robotaxi. We were present at the robotaxi day. We were impressed by the robotaxi. And so for Uber, they have to get past this moment, right, where, they have a hugely disruptive force coming in the case of Tesla. And now we know that the Trump administration is going to push, right, for a national regulatory change so that will be good for Waymo and good for Tesla. Now, Uber has a solution to this, right? They have Waymos on their platform, but we just want to see it play out. We want to see a few more months of this playing out. So, again, it comes back to portfolio management. For us, the optics right? And certainly right after the election, we bought more Tesla and we rotated out of our remaining Uber because we think the optics are going to be really tough for Uber over the course of the next few months. And they're going to be really good for Tesla as we get closer and closer to the launch of Robotaxi, which we think will be Q2 of next year.
This feels to me like, the goalposts moved.
Yeah.
Musk's proximity to power, that dynamic has changed. He is becoming quite obvious, a very influential voice in some of the policies that are going to happen, whether they are beneficial to him personally or beneficial to his companies, plural, because I think you could make that argument. That's what this strikes me as, is the goalposts moving in some respects to favor Tesla and in some respects hurt the competitors.
No, I would disagree with that. I think the
regulations that we said of ending the EV tax credits, easing the self-driving regulations, those are undeniable.
But if they change the regulations, but FSD wasn't killing it the way 12.5 is and the way FSD 13 is going, where you have 1,000x improvement in full self-driving safety in 1 year alone versus the 10% per year we were getting up until 2020 because we've gone from these deterministic models to these imitation learning models. It's about the performance at Tesla that is driving us. Now, sure, I think national regulation makes sense. In a country of interstate commerce, does it make sense that one state's going to allow me to drive my Tesla on full self-driving mode, then I get to the state intersection between Texas and Oklahoma, and I no longer can use full self-driving? I have to stop the car and change the mode of driving? That doesn't make any sense, right? We drive cars across state borders, so having a national regulatory framework, not just for Tesla, for everybody, for GM, for Waymo, for everybody, that's just the right policy. I don't think it's about favoring Musk or his companies, though I think regulatory clarity is needed in this country. But I look at it, it's the improvements that are going on in Tesla. And I think, 18 months ago, nobody would have said that this was winner take all or winner take most. They would have said everybody's going to have full self-driving capabilities. I will tell you right now, Tesla is running away with their full self-driving capabilities. The only other game in town really is Waymo.
So, Josh, I want your take on this because Uber's a large position for you. And, I don't recall you being as bullish on the Tesla FSD event as Brad certainly seems to have been. What's your take on him selling the stock here? I was just shocked, to be honest with you, when I heard about that move.
Brad's made a lot of money in the stock, and I completely understand his point. We're right now in this kind of gray area moment where it's unclear how the onset of AVs is actually going to play out. I want to say Silicon Valley is probably one of the greatest resources, natural resources, I would call it, we have in America. The people who live there, the people who risk capital, the people who invent things there have just done incredible things for this country. But as a East Coaster, as a Wall Streeter, I also want to point out the blind spot. They very oftentimes think that things are going to happen tomorrow that may not happen for 10 years. They have to think that way. It's endemic to the species, and thank God somebody does. Here in New York, we think more immediate. We think more cash flows. We don't think so much about what's going to change. We think about what's not going to change, and that's a little bit more of a New York mentality. And I will tell you what won't change. Most internet marketplaces are demand aggregators. That's how you win. In my view, the way this will all play out, Tesla's autonomous vehicles and cabs will be phenomenally successful, as will Waymo's, as will probably 2 or 3 other large-scale providers, because there are apps that will aggregate demand between all of them. I find it very hard to believe that you're going to have 10,000 Tesla full self-driving cabs on the street, and that's going to upend a company that has over 100 million users on their platform. The more likely scenario from where I sit, and again, I could be wrong too, the more likely scenario is that Uber is going to aggregate demand amongst all of the various players that have different types of autonomous vehicles on the road. The consumer is going to want one-stop shopping, not, hey, this time I want a two-door. That time I want maybe a moped. This app I'll go to because I want this. I don't think it's going to play out that way, and I think Uber is going to be the central demand aggregator, and that's the bet that I'm willing to make. Now, the stock might be volatile, and Brad might look right in the short term as Elon consolidates power and convinces Trump to push for things that benefit FSD. I won't deny that. The thing is, I'm willing to sit through it because I think the bigger story here has yet to play out.
Yeah, real quickly, Josh, I love the way Josh framed that. I think it's brilliant framing. To be clear, we were the biggest defenders of this stock from $15 to $80. We sold the stock much higher than the stock is at today, right? And I reserve the right. I may be buying this stock tomorrow or in a month or in 2 months. I just thought that the optics were going to be really challenging as we move into the launch of Robotaxi, which I think will occur next year. And this is not about regulatory capture. This is about the full self-driving capabilities, about FSD 13 at Tesla. Without that, there would be no investment going on in Tesla. People are excited about what they see with Optimus, what they see with full self-driving, what they see with the inexpensive cars they're putting on the road.
So as you can see, Brad isn't necessarily bearish. He is taking some profits. But I think that video does really well in highlighting the other side of the argument. The fact that Tesla and Waymo are going to take over with their autonomous vehicles and leave Uber behind. Now, let's hear from Uber's CEO real quick, and then I'll tell you what I think is going to happen with Uber and what I'm doing, if I'm buying or selling.
Uber reporting third quarter results, beating on the top and bottom lines. Here to break down the numbers and some of the key factors that are driving the business. Join us right now in an exclusive interview is Uber CEO Dara Khosrowshahi. It's great to see you. Before we get into it, Dara, I should mention, despite the numbers looking good, the market may not think that they're as good. Right now, the stock is off about 6%, and I'm curious what your reaction to that is and why you think that's the case.
Yeah, it's really tough to gauge market expectations, but for us, actually, we came in on a gross bookings top line, growing 20% right at our own expectations as well. Our EBITDA came in at record levels, $1.7 billion, up 55% as well. Free cash flow over $2 billion, and operating income over $1 billion, another record for the company. So we're very excited about the delivery of the results this quarter and incredibly optimistic about where we're going from here.
Let's talk mobility. So revenue up 26% year over year, driven in large part by trip volumes. Where are you seeing that? Is that more of an international play right now, or is that more U.S.? How do you go ahead?
Yeah, well, we see pretty broad strength in terms of trip volumes, but especially outside of the U.S. and the international markets. When you look at the APAC markets or European markets and Latin American markets as well, there's a number of newer products that we're launching. Two-wheelers, for example, in Latin America, or three-wheelers in India as well. And this is resulting in very, very high trip growth as we lower the price and make the service available to a much higher percentage of the population in those markets. So we're absolutely seeing very strong growth in the international markets.
Delivery business, trip volume driving about 18% of the growth year over year. How much pricing power do you have on the delivery piece at this point?
Well, I think that we've seen in delivery that it's a very, very sticky habit. Audiences are at all-time highs. Frequency continues to increase as well. And then really on the price side, we are focused on making sure that delivery is as affordable as it can be. And that comes in a couple of ways. One is with our membership program. So we now have 25 million members in our program. You get free delivery, you get discounts on delivery as well, and mobility. The number of members is up 70% year on year. So higher and higher percentage of our consumers are getting a more affordable service, both for delivery and mobility. And as a result, they're much more sticky to our product. They transact or spend 3 times more than non-members do. And then we're also working with a bunch of merchants as well. And you might see it on NFL game day, 50% off wings, et cetera. to get special deals to our members and all of our customers at Uber Eats as well. We call them merchant-funded offers, and the percentage of offers now running through the system are at all-time highs as well. So while we do think we have pricing power, and we've seen that over the past couple of years, we're actively working to make delivery and mobility more affordable for everybody.
Got to ask you about the big headline that we reported, and a lot of folks have been talking about for a couple of weeks now. This news that you have been discussing the possibility of wanting to acquire Expedia, a company, of course, that you used to run. What can you tell us?
Well, Andrew, I'm sure that you'd be shocked to know that we're definitely not commenting on any particular deal one way or the other. For us, our focus right now is organic growth. And when you have a business that's growing top line at 20+%, you've got bottom line growing at 50+%. We have free cash flow now that we're allocating more and more to buying back our own shares. So you combine kind of the compounding of bottom line and reducing share count that we expect to start doing next year, you get very, very high returns for shareholders. So for us right now, the bar for any kind of acquisition has never been higher, and the focus is really on organic growth. To the extent that we go out and do M&A, it will tend to be, at this point, smaller deals that are much more kind of closer to home in terms of what we do. An example of that is a proposed deal to buy Foodpanda in Taiwan. We're not looking at this point to do big deals, transformational deals one way or the other. And really the focus is on organic growth, because the organic growth is at still a very, very high level.
You don't need to say it. I will then read between the lines. It sounds like this is not something that is in the offing. Maybe I'm getting that right. Maybe I'm getting it wrong. Let me ask you a different related, though, question. Long term, there's been this talk, and you've talked about it, about this sort of super app idea, using the Uber app as a platform for all sorts of things. How should the investor class think about that?
Well, it's something that's well along the way. We have essentially a super app, or really a family of apps that people are using every day, and we want to make it an everyday habit, going anywhere, getting anything. So, for example, you see us adding more product on our mobility app. We're actually adding trains, for example, in the UK, and we've just started launching trains in Spain as well. In delivery, we started with restaurants, and now we've got grocery. You can get pet food. And really expanding the kinds of services that we have on delivery as well. So we are slowly but surely building that super app that can be your operating system in your local town. Anything and everything that you want, anywhere you want to go, anyhow you want to get there, we as Uber want to be there for you. And we'll have a membership program that embeds you into our ecosystem even more and more. So we're well along the way. There's no other company that's trying to do this, and there's no other company that's executing that local super app vision as we are.
Okay, so that was all the videos. I gotta say, I agree most with Josh Brown's take on this. That was the second video. Investors are kind of acting like this is a winner-takes-all industry, and just because Tesla and Waymo are progressing, Uber's days are over. I believe Uber's network is going to be so valuable, and there are a number of serious players. You have obviously Google's Waymo, you have Tesla, you have Amazon's Zoox, and you have General Motors Cruise. And all of these companies are either on the road or testing in some city in the US currently. So I think it's going to be a case of which of these companies is going to be the first one to tap into Uber's network and start offering rides to the masses, start generating revenue that way. I don't think it's going to be none of them. And I don't think all of them are going to be convinced that they can build and promote an app like Uber has. Not to mention, Uber recently partnered with NVIDIA to accelerate autonomous mobility. The more autonomous vehicle solutions that are out there, the more partnerships Uber can get, in my opinion. And in this article, they highlight, or the CEO of Uber highlights, generative AI will power the future of mobility, requiring both rich data and very powerful compute. By working with NVIDIA, we are confident that we can help supercharge the timeline for safe and scalable autonomous driving solutions for the industry. And this came out here at the start of the year. The article goes on to explain that millions of trips occur every day on Uber, representing a vast and rich source of data that the companies will look to pair with the NVIDIA Cosmos platform and NVIDIA DGX Cloud to help AV partners build stronger AI models even more efficiently. So clearly, Uber is pushing to ensure that there are a lot of competitors in this market. And as I said earlier, the more viable solutions there are out there, the more potential partnerships Uber can get. And that's the way I see this. And if for some reason no company wants to partner with Uber, what's stopping Uber from going out and getting their own fleet of self-driving cars and slowly rolling those out in different markets? What about regulation and having to get licensing from different cities and states? As we've seen, Tesla, Waymo, Cruise, and Zoox are slowly starting to test and gain licensing in select cities. From what I can tell from my research, going through this comprehensive testing process and gaining the license can take many years, depending on the state. Do you think customers will want to jump between apps and try to figure out which company has the right to operate in the city they're in? Or do you think they're just going to jump on Uber, an app they probably already have and are familiar with, and just pick whatever's there? I think that's the most likely scenario, and I think in the end we're probably just going to pick what's cheapest. So with how fast this company is growing and at their current valuation, I think this is an extremely attractive buying opportunity. And that's why I've been buying this one. Over the past couple of weeks, I have grown this to be the fourth biggest position in the portfolio. The average cost is just around $66. Currently have a total return of over $200 so far. I actually bought shares today. I bought a few shares today, so I'm still buying this one because it's just such an attractive valuation. Yeah, we'll have to see who's right in the end on all this. Let me know what you think is going to happen in the comments, and see you in the next one.